Hi, everybody. Jeff Yasteen here. I've seen the rising levels of disbelief in this current market rally. The gains from this kind of rebound are, one for the ages, and that is if you're invested in it. And I have to tell you, so is the level of skepticism about this rally. And, quite rightly, I get it. But I think that it will keep going for far longer than many people expect. And here's why. We have a gap in the S&P 500. In this case, this is a huge gap for a major index like this. It's about 70 points wide between roughly 33.28 and 32.59. And gaps are created when basically prices move faster than the opinions of traders and other institutional investors who really help set the prices on things. And so you can understand why a gap would be created in this situation, because coming through February, we're at new all-time highs, marginal new all-time highs. And then what happens? Suddenly everyone realizes, the coronavirus is happening. It could really hurt the U.S. economy. And suddenly the realization happens on Friday, and here is the trading activity on Monday. And of course, we continue to fall in a basic cliff dive after that. So here's the market rally since then. And this goes back to what I wrote here for my subscribers. Gaps are made to be filled. This is something that was taught to me by some old-time traders years ago when I was a reporter working for PBS Nightly Business Report. And I used to go and interview traders and analysts and other people by phone or by satellite. And I would ask lots of questions beyond just what I needed for my news material. And I learned this. This is an old saying: gaps are made to be filled. So the idea is that stocks and market indexes are drawn towards these open gaps on charts, where basically the price, in the case of a gap pointing lower, the price finishes at one session and then opens sharply below that price in the following session. Of course, gaps can also be created on the upside as well, where everybody piles into a stock after the closing bell or before the opening bell of the next session of the stock market. And so when you see these things, the idea is that stocks and indexes are drawn towards these gaps, basically like a magnet, and they keep moving that way until the gap is filled. Now, it doesn't always happen that way. It doesn't always have to happen, on schedule either. Quite often, I've seen it where a stock that I've owned for a long time may move unexpectedly higher or decline sharply. And then when I look back on the chart, if there's a wide range there and it suddenly breaks out of that range, it will do so to fill a gap in the chart from weeks, months, and sometimes for years earlier, and then either continue or move higher. So that is what we're looking for, and that's what I'm expecting for the S&P 500. I expect to see the S&P 500 continue to move higher until it fills this gap here that was created back in late February by the S&P 500. Now, interestingly, the NASDAQ is about to move into the same gap area right now. My artwork's not too good here on this, but basically the gap is right here. If you look at my hand cursor, it's right here between roughly 95.60 or so and 93.07 on the S&P 500. And we can see that on the NASDAQ, and the NASDAQ is starting to penetrate this gap area. So that's something to look forward to. I'll take one last look here at the S&P 500. I expect the S&P 500 to continue to move higher until it fills this gap. At that point, it's a marker that we need to take stock of the market again, because there's no law saying it can't continue to move sideways to higher if we see more goosing, more monetary goosing from the Federal Reserve and from the Trump administration and from Congress, as well as perhaps a recovery of the economy faster than some expect. But it's also possible that we have unfinished business here and the market moves to fill this gap before it then finally reverses lower And again, it doesn't have to be immediate. It could be something where the index actually moves sideways for some period of time. In fact, I want to show you one idea here. Setting aside the gap, talk about the gap. Let's look at the S&P 500 during the dot-com bubble and bust really fast here. So this is the S&P 500 back in March. Let me just widen it out just a tiny bit here. So there you can see it. This is the S&P 500 in the year 2000, which we all know, or many of us know, that the NASDAQ had obviously a huge bubble going on. That bubble popped basically in March. We see the S&P 500 here. It peaks in March 27th of 2000. But even though the NASDAQ has popped, and I think most people begin to sort of recognize that something might be wrong with the NASDAQ if you were fully sucked into the dot-com rally of those days, what happens? The market doesn't just fall like a rock in the way that we saw in February, March for our own markets in recent months. What happens? It moves sideways. In fact, look here. This is Labor Day, or leading up to Labor Day weekend in September of 2000. And the S&P 500 almost sets a brand new all-time high. And then what happens after that? Well, if I widen my chart out, you can see where suddenly that's where the bear market hooks everyone. And the S&P 500, as well as the NASDAQ, of course, just falls and falls and falls through 2001, through 2002, and does not bottom, in fact, until March of 2003. So my point here is keep your eye on that gap in the S&P 500. When that gets filled, presuming I'm right, when that gets filled, that will be our next step to see whether the market can somehow continue to move sideways to higher. If suddenly the market that the economy catches fire faster than many somehow might expect, or if we're going to see a reversal at some point in the weeks or months beyond that, which would be sort of the hook, the trap, if you will, that creates the true bear market that many of us would otherwise certainly be worrying about. Keep that in mind. Make sure to subscribe to my YouTube channel and follow me on social media. I'm Jeff Yasteen, wishing you the best of goodbyes.